Today we'll be starting with our second unit of our second subunit for our first unit of REG, which is tax preparers, professional conduct, penalties, and sanctions. Now, first, let's see professional conduct. Now, whoever professionals are there working as CPAs or any other or under any other profession, they need to maintain certain codes of conduct to remain in ethics and to to carry out some professional responsibilities ethically and also in a dignified manner. We're going to see what certified public accountants, what or rather I would say what tax preparer shall uh, comply to be able to carry out his or her responsibilities in a dignified and in an ethical manner. Now, let's come to your. We'll be mainly following the book, and as and when we'll need some understanding for any particular part, we'll be going into our notes. So, let's first come into first part rules of conduct before the IRS. 9 elements. So, there are some 9 elements which show us some professional conduct ethics. What are they? First, it's written conflict of interests. So, what do you mean by conflict of interests? Conflict of interests means that when you are carrying out, when your practitioner is carrying out representations for one client, it shall not be directly adverse to another client. What do you mean by directly adverse? Directly adverse means it should the representation for one client shall not be harmful or shall not have any negative effects for the another client. How can it have? For example, there is a CPA who is conducting activities for a particular client, say ABC Limited. Okay, some representation activities are being carried out, and also, for example, the CPA also has another client, say XYZ Limited, who has filed a lawsuit, a corporate lawsuit against ABC Limited. So, what shall be kept in mind by the CPA is, or by the tax preparer, by the practitioner, is that while representing for ABC Limited, he or she is not carrying out any activity which will have negative effects or which will adversely affect client XYZ. Okay. Next, there is a significant risk that the representation of one or more clients will be materially limited by the practitioner's responsibilities to another or former client, a third person, or by the practitioner's personal interests. What does this mean? For example, there is a CPA who is conducting, just a second. Uh, yeah, there's a CPA conducting activities for ABC Limited. Any representation. What do you mean by any representation? Say representing any tax matter. Okay. Now, what's happening is that he's conducting certain activities for the purpose of representation. For example, he conducted certain inquiries, investigations. He would have conducted, he would have taken more 3 days to complete the whole process. The prescribed and the faithful, the correct process should have taken more 3 days. But the CPA did not did not do the extra work. What did the CPA do? CPA limited his representations to certain part of the um, engagement only. Why? Because if he would have done this, then this would have a negative effect on its other client, say XYZ, who has made a lawsuit on ABC. So, by conducting this activity, either XYZ would have got adversely affected. That's why he did not conduct these activities. What was the result? The result was that his representation got materially limited due to any another client. It could also be former client, present client, or it could be CPA's own personal interests as well. For example, what ABC Limited offered CPA to give him extra 10 say 10 lakh dollars as compensation if CPA does not carry out some extra activities which CPA planned to. What happened? Due to some personal interests, the CPA materially limited his representation. Next, a practitioner may represent conflicting interests before the client only if. Now, here they have given first, when does conflict of interest arise? Second, even if there is conflict of interest, still a practitioner can represent only if these three conditions have been satisfied. Number one, directly affected parties all directly affected parties provide informed written consent once the existence of the conflict is known by the practitioner must be provided within 30 days of informed consent. What does this mean? Here, there were three parties affected: the CPA, ABC, and XYZ. So, all the affected parties shall both the parties ABC and XYZ shall be provided a written informed. What informed means? Informed means kind of oral. Informed and written consent of such conflict. Okay, means these parties shall provide written consent that they are having no objections with the conflict. Correct? And remember, these written consent shall be within 30 days. Means, for example, on 1st October, informed of the consent. Information has been provided. Before 31st October, written shall also be provided. Written consent shall also be provided. Next, representation is not prohibited by law. Law means the law which governs them does not prohibit it, of course. Next, the practitioner reasonably believes that he or she can provide competent and diligent representation to each client. This means when CPA believes that these 3 days of extra work is not even that necessary for the completion of a diligent work for 100% compliance and competence with his work, then he can go forward with such kind of representation. Next, a practitioner is not required to disclose the conflict of interest to the IRS. This means that this interest, if all these requirements have been fulfilled, then CPA, it is not necessary to inform of this IRS to the inform the IRS of the conflict of interest. Next, we have diligence. Now, diligence, in last class also we talked about diligence. Diligence means that whatever preparations have been done, whatever approvals, preparations have been done while while considering all the documents and all the matters while representing the IRS, all the IRS matters, all those have been prepared with utmost care, with it has been kept in mind, it has been made sure that no error has been made, and it has been made in a faithful and true manner. Means there is no known deficiency in the documents or the matters considered. So, what they have written, exercised. This is presumed if the practitioner relies upon the work product of another person and uses reasonable. Okay, screen must be visible now. Yeah, screen must be visible now. Sorry, it was not yet visible. So we did CPA's first point, conflict of interest here. We took the example of ABC Limited and XYZ Limited, and we saw if XYZ is adversely affected, and it is called conflict of interest. And if conflict of interest matters can be represented if informed and written consent is provided. Next, went to diligence. So here we have then and uses reasonable care in engaging, supervising, training, and evaluating the person. Means when you are carrying out any activity while preparing documentation or you are either investigating someone, utmost care shall be taken into in a faithful manner. Next, informational records. Informational records. What now? All the records that have been asked that have been asked by the IRS and that are required to be submitted shall be properly and duly submitted within the time given, and it shall be submitted an, by an authorized officer or employer of the IRS. So here they have given if reasonable access for a good faith belief that the information is privileged or request is not proper and lawful. What does this mean? This means, for example, if it's suspected that the information was not full and the request for, say, information documents wasn't that proper, wasn't really required, and the tax preparer has provided a valid basis. Reasonable basis means a valid point which has been made in good faith without any signs of fraud. Then that means then the practitioner may be excused or is excused from submitting such information. Next, if a practitioner does not have possession or control of the requested information, the practitioner is required to. Okay, here they have said, for example, if a practitioner has been asked for certain information or record, but if the practitioner himself or herself does not have such documents, he or she does not own that document himself or herself, then what will the practitioner have to do? The practitioner will have to give information, give details of that person who he or she believes would have the information or records available with him or her. Okay. For example, CPA was asked for some forms, okay, but does not possess it. So, what will CPA do? CPA will advise some other person, say person P, who has the forms. Okay. Next, known client non compliance. Now, if the practitioner is aware of any non compliance that has been conducted by the client, then what has no, any non compliance, or say a client has made some errors in his records, then what will do? The practitioner will immediately have to inform the client of such non compliance or of such error that falls in his or her document. And also, the practitioner will have to inform the also have to inform the client regarding what can be the um, what can be the consequences, what can happen because of the non-compliance, what, for example, what penalties will client may have to pay due to such non-compliance or such error. Now they have written circular 230 does not require the practitioner to notify the IRS. Next, practitioner must not negotiate any income tax refund check issued to a client. What does this mean? Tell me. They have written not negotiate income tax refund check. This means now this is a check which is issued to a client by the tax authorities that this much refund they have they will be getting. For example, they have got they have say got a refund check of, I'm sorry, this is very increasing, say a refund check of say $100 have been issued, that $100 of refund will be getting to the client. Now, tax preparer cannot be negotiating for this $100. It can't say that it shall be $200. This negotiation for a refund tax check is not allowed to a tax preparer. Okay. Next, may not charge an unconscionable fee connection with any matter before the IRS. Unconscionable fee means any fee which is kind of contingent. Okay, what do you mean by that? Unconscionable fee means contingent upon certain requirements, or unconscionable fee means, for example, a tax preparer has represented before the IRS, and usual fee is same $1 lakh. Okay, but the tax preparer has charged, say, 150 lakh, sorry, 1,50,000 dollars. So this $50,000 is unconscionable fee, which is unreasonable, which shall not have been asked. Next, contingent fees may not. Contingent fees means um, fees that is dependent upon some findings. For example, the CPA says that I will be charging say 20% of what your income is, or 20% of your tax savings, or 50% of your tax savings. That CPA cannot do. That means it is, the fee is contingent upon the tax findings, sorry, tax savings. Here there is an exception that, um, except in relation to an IRS examination of an original return, amended return, claim for refund or credit, or judicial proceeding. So in these case, the CPA can charge a contingent fees. Next, return of client records. Now, when the tax preparer represents before the IRS, the tax preparer, you know what, tax preparer requires some client's records to be able to be aware of all the information for the representation. So, after the representation has been done, or after he has been aware, or after he has, uh, the work of those clients records are over, are fulfilled, it shall be returned to the client again, even if any dispute, even if any fees, fees is pending to be received. He cannot say that I am still to receive some, say, $200 of my fees. It is still in dispute, and that's why I won't give the client records. That is not permitted. Client records are the property of the clients, and that's why they shall be returned to the client in all cases. Then they are written, however, now practitioner can retain copies of the client's photocopies, of course. Documents prepared by the practitioner. Now, here they have written client records. There are some documents which practitioner prepares himself or herself on the basis of the other information. For example, a tax liability working is prepared by the tax preparer. So, what will happen is that these records do not include those documents which practitioner prepares himself or herself. Next, now circular. This is an important part. Circular 213 allows advertising and solicitation with the following conditions. Now, here they are saying tax preparer can advertise and solicit. Solicit means inducing or inducing people to take your services. Okay, following conditions, then they can. What the written false, fraudful statements or claims not allowed, subject to factual verification. Means whatever they are claiming, whatever they are saying that yes, they provide such services, they all shall be true and made in good faith, and proper verification of their statements shall also be done. Next, specialized expertise may not be claimed. If they are saying they are providing some services, they they shall not be, they won't be asked for special expertise in those fields. But some state agencies or government agencies can ask for such expertise. Next, they are saying what fees can be advertised. So they are saying for specific fixed fees for specific routine services, range of fees for particular services, initial consultation fee, hourly rates, and availability of a written fee schedule. These all are quite generic and logical fees as well. Next, we come to best practices for tax return preparers. So, um, hmm, okay. So, what here they are writing, let's see. They should provide clients with the highest quality representation regarding federal tax issues, best practices in providing advice and preparing assistant. So, they are saying they should be following best practices. Now, what best practices include? We are saying best practices shall be adhered in providing advice and preparing information. What best practices really include here, we'll see. First, performing steps needed to report the facts for tax filing. Practitioners should establish facts, determine which are relevant, evaluate reasonableness or representations, relate applicable law, and arrive to a conclusion supported by law and facts. This means that when a tax preparer is engaged in tax filing, then he should keep in mind all the facts that are available to him. He should evaluate those facts which are relevant, which are not relevant, which are material, which are not material, and also consider all the assumptions that have been taken into mind, whether the assumptions are correct or not. Also, then, after considering all the relevant laws and regulations, all the tax laws, they will come to a conclusion. They'll come to a conclusion of the steps that they need to take for the fact supporting criteria. Next, communicating clearly. Now, when when a tax preparer is engaged with a client for any kind of engagement, for any kind of activity to be done, client shall clearly the tax preparer, the practitioner shall clearly communicate what terms means terms and conditions, or what are the terms and conditions of this engagement, so that no dispute, no misunderstanding further arises between the client and the practitioner. Next, advising the client regarding the importance of the conclusions reached, including, for example, whether taxpayer may avoid accuracy related penalties under the IRC if a taxpayer acts in reliance on the advice. Means if a particular conclusion has been reached upon. For example, if a conclusion has been made that some 10 documents to be submitted more. Okay, what practitioner will do? Practitioner will um, practitioner will say why this is required, why is it important, why it needs to be done, basically. Next, acting fairly and with integrity in practice before the IRS. So these are the best practices. These are the elements which are included in the best practices for tax return preparers. Next, written tax advice. Now, what is this? Last class, we studied the first unit where I told you regarding some written advice that are to be provided. That many a times practitioners, CPAs provide their clients. What is that written tax advice? Written tax advice is something um, in writing. Practitioners advise them something for some event. For example, if any transaction has been taken place, any material transaction, for example, any merger has been taken place, on that a written advice they will give on the tax matter of the transaction. Then that is written tax advice. Now, what they have written? When providing advice on federal tax matter, a practitioner must base the advice on reasonable assumptions, of course, reasonably consider all relevant facts that are known or should be known, and use reasonable efforts to identify and determine the relevant facts. Means this advice shall be based on some assumptions, okay, assumptions which are correct in these facts and circumstances of the case. Second, also reasonably, all facts and circumstances shall be considered while giving the written tax advice. Last, other facts shall be known after taking some efforts to gather those facts, those relevant facts. Next, now advice. Now, because it is a written tax advice, the tax preparer is taking upon herself or himself a liability of the advice, whatever he or she gives as a written tax advice. It works as a confirmation. It works as a certification that whatever advice contains is correct. So the advice shall not only reply the tax preparer shall not only rely on statements or representations, statements, findings of others. He or she shall also check whether they are correct or not, whether they are complete or not, and consistent or not. Okay. So, the written tax advice shall be provided by the tax preparer in good faith, and it shall be made after considering reasonable assumptions and considering all the facts and circumstances of the case. Next, we come to penalties, one of the important parts of this subunit. Now, what do you mean by penalties? Just by the word penalties, what do you mean? Clearly, penalties mean consequences of violations. What violations? Violations of tax laws or case laws. Okay. So, Tax return preparer, as we saw, they are subject to certain codes of conducts. Okay. Also, some best practices and many other points govern them. Now, on violating, or violating means on not adhering to any of the tax laws or regulations, the tax return preparer will be exposed to several penalties which can impair the practitioner for a material period of time, for a good period of time. Now, those penalties vary on the degree of the violation made by the tax return preparer. Let's see into that. First, they have given us unreasonable positions. What does this mean? They have written taking an undisclosed position without a reasonable belief that substantial authority exists, that it will be sustained on its merits, results in a penalty of an amount equal to or greater of $1,000 or 50% of the income to be derived. What does this mean? This means, say, the there is some position of the practitioner. There is some the practitioner is in some position, but that position is not reasonable. Means the practitioner is being given some, say, amount, though he is not entitled to get it. For example, the practitioner has done some work and he is entitled only $10,000, but he is in a position of dollars 1 lakh. In this case, this is an unreasonable position. So, what will happen if this unreasonable position is remaining undisclosed? Then the CPA will be charged penalty of more of whichever is more will be the penalty, $1,000 or 50% of the income to be derived. If the position is disclosed, now if disclosure has been made, obviously the reasonable disclosure shall be there, or the disclosure shall show that this unreasonable position that is being evident otherwise is actually reasonable. This 1 lakh dollars has been taken on a reasonable basis and not unreasonable position. Next, does not apply if preparer acts in good faith and reasonable cause exists for the misstatement. Means there was no intention of fraud. Also, for this understatement, there is a valid reason, because many a times some disclosures may lead to adverse effects which are greater than the positive effects of the disclosure. Okay, so here we have seen that the penalty will not apply in these two cases. Next, related to tax shelters are positions related to tax shelters are unreasonable unless reasonable belief exists that such position would more likely than not be sustained on their merits. Means Tax shelters means to be saved from tax, nothing else. Okay. So whatever position which leads to protection from tax is not allowed unless unless there is a belief that the position would not be sustained on their merits. Next, negligence. Negligence is nothing but carelessness. If there is carelessness that was conducted during the preparation or tax filing work, then penalty would be charged. Next, willful or reckless conduct means intentionally there was wrong conduct being made. In that case, penalty would be greater of $5,000 or 75% of the income. Now, here there has been, because there was a willful intention, a you know intentionally wrong statement or understatement was made. In that case, penalty is higher. Then we have frivolous submission. What does this mean? Frivolous submission means when you are submitting tax filings or any documents to the IRS, then that submission, those documents contain any kind of error or omission or something fishy in it. For example, they have given omits information necessary to determine the tax liability, shows substantially incorrect or willful understatement of tax liability based on frivolous position or based on taxpayers' desire to impede the collection of tax. Simple. Next, tax code provides that any preparer who endorses or otherwise negotiates any check. Okay. Now, if say IRC means Indian Revenue Code, sorry, Internal Revenue Code, if the Internal Revenue Code say has imposed any, your impose your client with some tax payment. If IRC has said your client ABC to pay say $50,000, the tax preparer cannot negotiate the IRC to less it. If he does, then penalty, what's written here? Yeah, 635 per check means per document of negotiation. Next, furthermore, so here they have written for negotiations. Next, they have aiding or abetting. This means if any document, if you were to submit any document to the IRC, if you have made some, you know, for example, you have made some statements or some, you have not made some statements, and that results in understatement and result of which your tax liability is decreased, okay, then that is called aiding or abetting and penalty would be charged. For let's see, subject to only one. However, now a tax preparer may have, say, done, a lot of aiding and abetting, but he would be subject to only one aiding per client. For example, maybe in one client only, the preparer has made some 10, some such understatements, but it will be counted as one for each taxpayer. Next, now this part is simple only. You can do it. Next, fraud and false statements. If any fraud or fake statements have been provided intentionally, again here intention comes, so the penalty is high. What is it? Fine not greater than $250,000 for one client and 5 lakh for a corporate client, means 250,000 for individual and 500,000 for corporate client. On top of that, imprisonment of till 3 years, either of them or both of them. Okay. Next, disclosure of taxpayer information. Now, if any tax preparer has disclosed or has, has disclosed some information of its client to the disclose some information of the client without taking the permission of the client, means the client may may not be okay with with the information getting disclosed. In that case, penalty would be imposed. Why? Because disclosure was made without the consent, right? What is the penalty? 250 $250 per disclosure with a maximum of $10,000 per year. So here there is a cap. If so, now we come to next part of exceptions. In exceptions, what they have given is that in the following cases, the penalty would not be imposed on the tax preparer. So, what are these cases? So, number one, if disclosure, okay, if disclosure was made in accordance with the Internal Revenue Code, means IRC has given the permission, okay, to a related taxpayer, provided the taxpayer did not expressly prohibit the disclosure, means the taxpayer did not say that the disclosure shall not be made. Third, under a court order or to the tax. Now, if any court order has been received, if the court has given us the obligation to disclose a particular information, then what will happen? Then even after disclosing, there will be no penalty. Next, two tax return preparers within the same firm. If the preparer is a part of a firm, then he can disclose the information to other preparers for further discussions and for being able to arrive at the best conclusion. Next, for the purpose of a quality or peer review. Now, for every jurisdictions, there's some quality or peer review. What is that? Quality peer review is there is another organization, a governing body that audits the firms whether they have performed the statutory and the yearly audits correctly or not. That is peer and quality review. So, for those purposes, disclosure may be made. Next, for preparing, okay, if the information is required was required for tax return preparation, then also it is allowed, no penalty would be imposed. Next we have consent. So a taxpayer shall give his consent to the client that that the taxpayer shall give consent to the tax preparer that he or she is okay with disclosing of the information. Remember, the consent shall be written formal consent, not oral. Okay? And also, that consent should also include the specific purpose for which the consent was provided. Next, the tax preparer must authorize a preparer to use the information to solicit additional current business from the taxpayer, disclose to additional third parties, disclose in connection with another person's return. So, these are the other points for which the tax payer may give his consent to the tax preparer. Next, we come to confidentiality. Under confidentiality, it is not confidentiality is something which is not only confined to tax preparers. For it is for many others as well. Here, privilege may not be asserted to prevent the disclosure of information to any regulatory body other than the IRS. In non-criminal tax proceedings before the IRS, taxpayer is entitled to common law protections of confidentiality with respect to advice given by any federal authority authorized tax practitioner. They are the same protections a taxpayer would have if the advising individual were an attorney. A federal authorized tax practitioner, who is he? He is any non-attorney who is authorized to practice before the IRS, such as a CPA. Then tax advice, this we have already seen, respect advice given by individual with respect to matters which are within the scope of its authority. So here they have written that any apart from IRS, for any other regulatory body, the privilege shall not be asserted to prevent the disclosure. Means the disclosure shall be made. Okay. For any regulatory governing body who is asking for information, you will have to give it, right? Next, we come to sanctions for violations. What here they have written? Now, till here we have seen penalties, right? Amounts, and only one part we saw imprisonment. What are the other, other actions which could be taken against the tax preparer on non-compliance or say any kind of error or fraud? So, what they have written? Taxpayers may be censored, suspended, or disbarred from practice for willful violations of any of the regulations contained in Circular 230. A notice of disbarment or suspension of CPA from practice before the IRS is issued to IRS employees, interested departments, and agencies. So, here they are written what can happen: suspension or disbarment. Means the practitioner cannot further take up practice. Then the notice, to whom will it be given? It will be given to the employees, departments, and other agencies of the federal department, sorry, federal government, and also, of course, the state licensing authorities. Next, who can they suspend or disbar or censor? Any practitioner who is shown to be incompetent or disreputable, refuses to comply with the rules and regulations relating to practice before the IRS, willfully and knowingly with intent to defraud, deceives, misleads, or threatens any client, means any act which is against the ethical code of conduct, means is not competent enough, number one, and or doesn't have a good, doesn't project a good reputation, a bad reputation. Number two, doesn't follow the rules and regulations that must be followed before the IRS. And number three, intentionally he defrauds, misleads, or threatens the client. Next, what now below are some lists given that for which consequences of suspension or disbarment may occur. Now, these are very basic. We have already understood most of them. So, this you can just give it a reading and understand it properly. Okay. So, the next part we just go through here. Next page, they have given certain act, there's a summary of all the penalties and sanctions which we have seen till now. For different acts, different fines that can be penalized, and if there is any imprisonment as a consequence or not. So this you just give this for penalties overall for reg. I will suggest you to keep on revising every frequency, okay? Because this is not something that you just revise it today, you read it today, you or you learn today and you will remember it. No, you will have to keep it revising again and again. Then only you will be able to recall in your exam and answer. Okay, so here we have done a 1.2 second subunit. Next, go into a third subunit of the chapter, which is licensing and disciplinary systems. So here we see in your book first they have given two systems. First is state boards of accountancy. Now, state boards, these are governmental agencies that license accountants to use the designation CPA. Means this is the board that will be allowing you all who are studying CPA, after you pass your examinations, they will be giving you this designation, the license. They will be giving you the license, after which you will be able to put the designation CPA for your name. Requirements for licensure varies from state to state. In addition to passing the exam and preparing the applicable and paying the applicable license fee, candidate may need to satisfy a state's educational experience and residency criteria. Means now for license, we all know we need to pass the CPA exam, for which you are studying hard, correct? Also, then you have to pay the whatever required license fees they ask for becoming a CPA, for getting the license. Even after that, for your state, there may be certain specific additional criterias. For example, they may require some extra years of experience, some residency criteria for where you are living, how you are living, those criterias for your license. Next, continuing professional education, peer review, and ethical standards. Now, continuing professional education is, there are CPE hours that that CPAs need to fulfill. There are certain hours of education which CPAs need to attend for being able to retain the license, for being able to retain the membership. So those CPE, peer review, and also following the ethical standards, that also can vary. Next, state boards can suspend or revoke licenses to administrative purposes, for example, in board meetings. Then we will have, then we are last line they are saying state CPA societies are voluntary private entities that can admonish, suspend, or expel members. Okay. Next, we have AICPA disciplinary mechanisms. Here, first, we have Professional Ethics Division. Uh, this division investigates ethics violation by AICPA members. It also imposes sanctions in various serious cases. Means it will impose, if there is any serious case arise, any serious violation, then what shall be the consequence? What shall be the sanction as a result of that violation? That also the Professional Ethics Division takes. Next, Joint Ethics Enforcement Program. Now, the AICPA conducts such programs. They have AICPA and many states, they have agreements in between them. That such agreements which allow the CPAs to refer either of the two ethical compliances, not both. That is a mutually agreed agreement between the AICPA and the state authorities. So now AICPA considers matters more of national concern, and um, it will also include matters of all the states, two or many states. So here we have seen the systems. Next, we'll see liability to clients and third parties under state law. Now, what is this? Liability to clients and third parties under state law. Uh, so, we have already done 1.2 and 1.3, right? We have done 1.2 and 1.3. So, uh, let's do one thing. Okay, for 1.4, what they say. What do you mean by this? Liability to clients and third parties under state law. This means that you are having some, liability against, say, your liability towards your clients for whom you work, for whom you represent before the IRS. Third parties can be other affected parties as well. For example, parties which include the government organizations, the authorities, towards them also you may have certain liabilities under the state law. So, uh, now fourth and fifth part is more, theoretical, and it is more, it, it, it is very easy and it is more theoretical. So, for today, I would advise you to just go through the fourth and fifth part, just a blank reading, nothing else. Okay, just a blank reading, and then you on the next in the next class we will be taking up it in short. Okay. Also, in the next class, we will start with the second unit after completing 1.4 and 1.5. And in second unit, we will try to cover as much as is possible, because even that includes, authority only. So even that's the same thing. So we'll do that in the next class. Okay. I'll just drop off for today.